Barnett with Attract Capital, broadcasting live today on our continuing middle market growth series. Today's webinar is EBITDA as the coin of the realm. Well, what does coin of the realm mean before we get into what EBITDA means? Coin of the realm means something that you need to have in order to navigate a new area. It's a currency that allows you to get something of value. And if you think about cash flow lenders, if you think about what a middle market company needs, they need, if they go looking for cash flow lenders, they're going to be looking in a new realm. They're going to be in a kingdom where there's a lot of castles. And you need to have coins so that when you go up to the castle and you knock on the door, you can give the coins to the person at the castle and get a loan in return. So that's why we talk about EBITDA as being the coin of the realm. You're in a new kingdom, you're in a new land, and you need to know what the valuable store of currency is. And my friends, it's EBITDA. Okay, so let's talk a little bit about what EBITDA is. EBITDA, simply known, and I think a lot of people in the Attract Capital universe know that it's earnings before interest, taxes, depreciation, and amortization. Okay, it is a bit of a proxy for cash flow, but it does exclude a few variables, EBITDA, and it's not quite the all-encompassing variable to look at a company's cash flow because it doesn't pick up how much money a company is spending on their equipment and their machinery to maintain their existing business. And it also doesn't pick up how the company's balance sheet is changing, if their inventory is going up or the receivables are going up. So while it is a proxy, it's a yardstick that cash flow lenders use. It's not a be-all and end-all. But there's a lot I can say about sort of a purist way of looking at EBITDA. Warren Buffett of Berkshire Hathaway doesn't like EBITDA very much because he thinks it only tells half the story. But the reality is that cash flow lenders love EBITDA. So if you want to be successful in this new kingdom of cash flow lending, you really need to know what EBITDA is, why they use EBITDA, and how you can navigate the nuances of EBITDA to have more coin. So let's talk a little bit about how it evolved. EBITDA evolved from the private equity world and the leverage lending world back in the 70s, and it was a way to think about how much a private equity group was buying a company for. They might be buying it for 10 times EBITDA, they might be buying it for 20 times EBITDA, but basically it was a valuation metric that has been widely adopted. I find historically, having bought companies, having run companies, having been the CFO and raised a lot of financing for companies, that it's a great way of gauging cash flow for companies that are asset light and have high margins. It's not such a great way of measuring cash flow for companies that are low margin and have asset heavy balance sheets. And I do find it a little bit overused. So when you're a lender and you get a company that approaches you and you're looking at that company, what are the things that you're screening? You're looking at historical financials, you're looking at what the company does from an industry standpoint, you're looking at the deal dynamics. Most importantly, cash flow lenders are looking at the EBITDA. Okay, they're looking at the EBITDA because EBITDA in and amongst itself can tell a lender about that company. It sounds a little unusual to be able to say that they can look at EBITDA and they can learn a lot about a company, but they really can. So what are the things that they're learning about? Well, they're looking at your EBITDA margin. So they're looking at EBITDA divided into your revenue. So they typically use a 10% level. So if your EBITDA is $10 and your revenue is $100, that's a 10% EBITDA margin. Most cash flow lenders don't like funding companies that have an EBITDA margin any lower than 10%. It may sound strange that they're hard line about that, but their view is that if you're any less than a 10% EBITDA margin business, you're not specialized. You don't have high enough margins. And probably most importantly, if you're lower than 10%, you don't have enough defensibility or you don't have enough franchise value to your business. So if you're over 10%, most cash flow lenders believe that you're in a niche, that you're specialized, and then you're going to have staying power over the long term. Cash flow lenders need your EBITDA to have staying power because they're really relying not on the assets in your business, not on the cash flow in year 1, but the cash flow in years 3, 4, 5, and 6 for you to get repaid. If your EBITDA margin goes from 10% to 5% to 1%, in the outer years, there's not enough cash flow to repay the loan. So what you really need to do is understand the way they're looking at it. 10% and higher gives you a lot of coin in the realm when it comes to how the mezzanine lenders and how all the cash flow lenders for that matter are screening you. Generally speaking, low margin EBITDA businesses defined as, I'd say, 8% or lower. I mean, if you're between 8 and 10%, you can usually get the interest of a lender because you can make arguments about how they might look at revenue and why your EBITDA margin might be understated, why from an economic substance standpoint, it's really probably higher. But if you're lower than 8%, if you're at 5%, if you're at 2%, it's a difficult road to hoe to get a cash flow lender to think that you're that specialized, to think that you're going to have staying power, and to think that you're in a niche that is going to allow you to produce consistent cash flow over the life of the loan. These cash flow lenders need you to have consistent cash flow. So why is this EBITDA so important? So it's important because cash flow lenders look at your business and they'll come up with a multiple or a multiplier, a lot of people call it. And that multiplier, they'll say, well, whatever your EBITDA is, we'll give you a 3 times multiplier. Whatever your EBITDA is, we'll give you a 4 times multiplier. Well, that determines how big of a loan you're going to get. So back to the kingdom of the realm that we're in of the cash flow lenders, when you're knocking on the door of the castle and you're giving them your coins, you want as big a loan as possible. So you want to work with a lender in the castle that's going to give you a 3 times loan. So he's going to give you 3 times, and the question is, what is your EBITDA? So if your EBITDA is $2 million, you're going to get a $6 million loan. If your EBITDA is $4 million, you're going to get a $12 million loan. So the amount of the EBITDA difference between what you have when you present your deal to the lender has dramatic impact on the size of the loan. And it often is the difference between getting a deal done at an acceptable amount of money or a deal not getting done because there's just simply not enough money to buy the other company, to cash out an owner, or to fund an expansion plan for a business. Most businesses, middle market growth businesses, need more money. The money is the fuel for the growth plan. So understanding EBITDA and how you can increase it within the acceptable conventions of the lender is critically important. So let's talk about adjusted EBITDA, because we have actual EBITDA, which is the EBITDA that your accountant will say at the end of the year that you actually earned, and then you have adjusted pro forma EBITDA. These are 2 completely different numbers, the historical actual and the pro forma adjusted. Never the 2 shall meet, because there's probably never a company that can't use an adjustment or an add back philosophy when they're trying to raise money from a lender. So what do we mean by add backs? Well, there's 2 types of add backs. Add backs are either things that have already occurred that will change, things that have already occurred, or things that you've already changed that will lower your costs in the future. So it's already happened, or the second is it is about to happen upon completion of an acquisition. If it's about to happen or if it's already happened, you have different ways of calculating the amount of the add back. So if it's already happened and the change is only shown up in, let's say, 1/4 of your financial statements, you have the ability to go back to the first 3 quarters of the year and to basically quantify all the money that would have been saved if you had made the change as of the first day of the fiscal year. So it's kind of like this add back is a little like magic. What you get to say is, well, we had this change as of October 1st, 2016, but with this add back adjustment ability, you have the chance to say, well, let's assume that change really occurred at January 1, 2016. So you pick up a whole, let's say the total dollar savings is $100. You picked up $25 in the 4th quarter. You have the ability to go back to the first 3 quarters and pick up another $75 in terms of the amount of the add back. So these add backs are generally expense related, and they tend to be, there's a number of different categories of these add backs. So the most common is known as one-time non-recurring expenses. These are things that you might have spent a lot of money on. They're non-recurring, they don't show up every year, or they're one-time, meaning that you've never had them before. So these can be, for example, legal expenses if you have some lawsuit that you're defending. It could be the expense or the money that you pay to an investment banker to try to get your deal going forward. It could be growth expenses. It could be something that you invested in some R&D, or you invested in an area of your business that you haven't before. So it's one time and non-recurring. It could also be restructuring expenses. These are where you might have had a division and you were phasing out that division, or it could be where you had staff and you found another way to do it more cost effectively, so you reduce staff. So it could be one-time non-recurring, it could be restructuring related. It could also be extraordinary events. Extraordinary events, I would characterize Hurricane Sandy. When Hurricane Sandy hit, most businesses in the Northeast were out of commission for about a week or two, so they didn't have any revenue because they couldn't open their businesses. So quantifying that lost revenue is a way to look at the add backs. And these are all add backs that have occurred already, not add backs that are about to occur, but things that have happened where you can quantify it from the beginning of the fiscal year period. So then there's add backs that will occur once the deal closes. Okay, so what are these add backs? Well, the owner of the business might be taking a lot of money out of the business. You get to add that back. You get to normalize his salary. That's an easy one. Let's say the acquiring company doesn't need all the people that are at the company. They have people on their own staff that can do the work, so there's economies of scale. You get to add that back. Let's say that the acquiring company has lower cost sources of product for purchasing. Let's say that they're purchasing raw materials. They could be purchasing just about anything that goes into their cost of goods sold. If they have a lower cost source of supply, if you can show that the company that you're acquiring has higher costs, you can add back the difference between the two. So that can be a very powerful add back. You can pick up a lot of extra EBITDA with that add back. You might have other administrative savings. You might have lower cost insurance, you might have lower cost payroll services, you might have lower cost IT services, all of which, if you're going to get out of the one business, you can use the lower costs of the acquiring business. The thing about these add backs that will occur in the future is that they're a bit more futuristic, they're a bit more on the come. However, these add backs, whether they've already occurred or if they're about to occur when the deal is consummated, can have a dramatic transformative effect. I repeat, a dramatic transformative effect on your adjusted EBITDA. It could really be the difference between going from 2 million in EBITDA up to 4 million in EBITDA. So it's really important for every business that's about to enter into the realm of cash flow lending to do their homework and to understand this. So, just to give you some context and some color, we've done a lot of deals where add backs were as high as 60 to 65 to even 70% of the adjusted EBITDA. So to put a number on that, let's say the company had 4 million in adjusted EBITDA, okay? At 30% of that was actual EBITDA that showed up on their financial statements that their accountant prepared, and 70% of that were adjustments. And they were all sorts of things. They were things that had already occurred, it was severance, it was restructuring, and things that were about to occur. Purchase cost savings, administrative cost savings, and owners' excess salary that the owners, and normalizing salaries from other people. So when you looked at the financials, when you looked at the confidential memorandum that the company put together, they had 1.2 million of historical EBITDA, and they had 2.8 million in add backs, which got them to 4 million in EBITDA. 1.2 actual, 2.8 adjustments, 4 million of adjusted pro forma EBITDA. So what did that do for the company? Okay, so, and honest and candidly, a company that only has 1.2 million of EBITDA, really, it's difficult for them to get a loan from a cash flow lender. But let's say that they could get a loan at a 3 times multiple. So 3 times 1.6, 3 times 1.2 is 3.6 million. Okay, when you get to the 4 million of EBITDA and you're at 3 times multiple times the 4 million in pro forma adjusted EBITDA, you're at 12 million. So it's the difference between 3.6 million and 12 million. which is a vast difference in loan amount. So the coin of the realm is really understanding this EBITDA and why it's important, because the lender will see you and judge you on your EBITDA. If you're more specialized, if you're in a niche, if your cash flow has staying power, they want to make a loan to you. But as important, it's understanding how these add backs are pivotal to you showing an adjusted EBITDA that will really result in you getting a much larger loan. So the coin of the realm is really finding ways that you can increase the amount of that loan and present your company to the lender in such a way that they're very comfortable with your staying power and they're willing to fund you to the maximum. So that in a nutshell is how you navigate the new kingdom of the cash flow world. We've had some questions as we're giving this webinar, and some of the questions I'm going to take, and somebody texted in, what about revenue add backs? We talked about expense add backs, we talked about excess and non-recurring expenses, but what about revenue add backs? Well, revenue add backs are very hard to justify. Most people, it's a hard thing to say to somebody, well, if we had done these things differently, we would have had these sales. So most lenders are not that interested in entertaining revenue add backs. They tend to be not well taken when you present them. The other question we had is, how do you document add backs? Well, the key to add backs being accepted is clarity and defensibility. You have to present your add backs with a lot of detail and a lot of supporting confirmation. And they have to make sense. So the best way to document them is to gather all your information internally and then to give them to an accounting firm that will actually run some analysis on them and vet the logic of them. So when you have an outsider, an accounting firm who's vetting the logic and actually confirming the calculation and tracing it to source documentation, it gives a lender a better degree of comfort that the add back just wasn't airily extracted, like just made up out of thin air. And then the other question we had is, do lenders really like add backs? So we're talking about, a deal can be, adjusted EBITDA can be 70% pro forma, 30% actual. A lot of lenders, the higher the percentage of adjustments, the less comfortable they are. So it's very difficult to take a company that's losing money on an EBITDA basis and flip it into a company that's making money on a pro forma EBITDA basis. No lender wants to go near that. The more actual EBITDA you have, the stronger your deal will be perceived. The stronger they perceive your deal, the less risk they see your deal, the higher the multiple you're going to get. So I would say in general, you want to have as low an add back. I mean, the perfect percentage, it's probably 75% actual, 25% add backs. And within the 25% add backs, easy things to explain, like the owner's salary, there might have had some severance, there might be some administrative savings, but things that the lender really doesn't have to think too hard about. The lenders, it's called execution risk, because a lot of times lenders are funding into deals based on these, grandiose add back scenarios. And what they find is that the management team just is not in a position to be able to capture all those savings, or more importantly, the add backs were just sort of a myth, that they funded into an add back story and the expenses related to a certain set of suppliers or a certain level of salary went away, but a whole new level of suppliers or salaries grew back. So it's sort of like the add back went away, but it came back again. And it's something that lenders don't like to see. It's kind of a circular thing where it just doesn't look like it's just not something that a lender really wants to get into. So document your add backs with a third party. Make sure that they're vetting the logic. Make sure that as much as you can do a deal with a high percentage of add backs, it's better not to have it. And make sure that when you go into this, you're understanding all the possible categories of add backs and the impact they have on the EBITDA. Because the higher the EBITDA, the more coin you have for the realm of the cash flow lending kingdom. So I want to thank everybody for joining us. And we're going to have another webinar at the end of August. And if you have any questions, if you have any emails, if you have any thoughts or observations about this webinar, please contact me at dbarnett@attractcapital.com. Everybody have a great weekend, and thanks for joining.